As under the IFRS 16, we discuss about fair value, we discuss about impairment, and so we have looked at impairment under IFRS 36. So right now we are looking at IFRS 13, and if you still remember, I told you that under IFRS 40 also we have a fair value measurement, and so it is important for you to have the basic understanding of what this IFRS 13 is talking about, and that will also guide you because going forward, we will be saying fair value, fair value, fair value, fair value. So, what is this fair value as it was a standard? So, that's what we are looking at to now in this class. Now, IFRS 13 provide a comprehensive framework for how we measure fair value. Remember, the title of the standard is fair value measurement. And I told you in the last class that whenever you see anything like measurement, we are talking about how are you going to calculate the value as it were. How do you calculation? That's basically what it's all about. You understand? And I told you whenever we're looking at standard, we look at recognition criteria, we look at measurement, we look at presentations, and then we look at disclosure. But for this particular standard, we may not need to look at recognition. Why? Because we are talking about measurement here. So we may look at measurement, we may look at majorly disclosure, measurement and then disclosure in this very standard. This standard, I can't like to test it very well. I will not lie to you. It's very simple a standard. Just listen. We just run through the what we have to now in this class, and I'm sure by the time we are done, you will have the basic understanding of it. So the objective is to define what exactly is fair value. Now, summarily, what I used to do in the class is what are you to know from this very standard? Number one, you must know, please be writing as I'm talking. It's very, very important, be writing. Number one, you must know the definition of fair value. What is fair value itself? That is very, very important. And then inside that number one, I will say number 1B. You need to know what are the major concepts that were defined under this under the IFRS 13. Some major components are in the definition. You need to know the content and the context of those items. It is just like when you are cooking your food now, you add Maggi, you add salt, you add every of that thing for you to make the soup to become a soup. So also there are some things that are inside that definition. You need to know them. So you need to know them. That's number 1B. Then number 2, what you need to know is what is exactly the price that you are to use under fair value. When we get there, you also understand. That's number 2. Number 3, you need to know the types of the market, that are available under the fair value measurement. And then number 4 now, you should know that there's what we call the levels, levels in fair value. So we have 3 basic levels. Very, very important for you to know that. And then number 5, you need to know the hierarchies. The hierarchies, we also talk about that. And then you need to know what we call the highest and best user approach under valuation. Very, very important. And then you also need to know what we call the valuation techniques. All of these are what we are going to look at in this very standard. And I'm sure by the time we are done, you will have a very good understanding of whatever it is that we have been looking at so far. So quickly, let's go to the definition. What is fair value itself? Fair value is a price that will be received. The price that will be received to sell an asset or pay to transfer a liability in an orderly transaction between market participants at measurement dates. The price that will be received if you are to sell an asset, what is the price that you will receive? Or if you are to transfer a liability, how much, what the price that you are going to pay for you to transfer a liability? And then take note of the following: orderly transactions, market participant, measurement date. Very, very important. These are the key things that you need to know in this definition. Number 1, the price that will be received or paid to transfer a liability. That's number 1, the price. Number 2, you need to know what is orderly transactions. And number 3, you need to know market participants. And then you need to know what is called the measurement date. And so, without much ado, let's go forward and discuss what exactly is this price. The price that we are talking about here is known as the exit price. we have two kinds of prices in the market. We have the entry price and we have the exit price. The entry price comprises of all the transaction cost, the purchase price itself, the transaction cost, and then sometimes the transport cost. That is what we know as a entry price. In other words, when we are defining the cost of an asset, if you can still remember that IFRS13, we talk about quite a number of other costs. We talk about the purchase price and then the excise duties. We talk about the cost of bringing the asset, to the state for use. We talk about dismantling and restoration costs, and all those ones are known as a transactional cost. And then there's also a transportation cost. You add it to it. That's what we call the entry price. Now, IFRS 13 is not in any way considering the entry price. We are particularly considering what we call the exit price. And that's why the definition says the price that will be received if you are to sell the asset. Note this, the price that will be received if you are to sell the asset. Note this, you are not selling the asset. You are only making what we call the best use of your judgment now. You are only fair value. You are trying to get what price. If all of these other prices, transactional cost, transport costs are not available, are not there, they are removed, what will be the price that will be remaining? Remember, you are not selling. You are not selling. That's why we say we have what we call the entry price and we have what we call the exit price. So the entry price is what comprises all the transactional costs, all the transport costs, all put together. That is, you want to sell the asset. Take for instance now, if you have a motor vehicle, you want to sell the motor vehicle. Now you give the motor vehicle to a vendor for you to sell for you. The vendor will charge commission. What about if you want to improve the asset as it were? What do we mean by improving? What if you want to improve the asset as it were? Well, that is to say, you want to paint the asset. You want to paint the motor vehicle, put it in other shape. All those costs, they are all transactional costs. But all of those ones, we are not going to consider them. Let's assume that, okay, you want to just sell the vehicle as it were. All of those costs, they are what you are going to be adding up as it were. So when we talk about the entry price comprises of all other costs, while the exit price is just the cost, the actual cost that the actual price that you will be willing to sell the asset or pay to transfer the liability. It's as simple as that. So please take note of that. It's very, very important that you understand it as it were. So that is that for that. So like I told us earlier, fair value is an exit price, not an entry price. Fair value is market-based and is not entity-specific. In other words, it is not what the entity will just decide that this is what it should be. It is market-based. Now, when we say market-based, you don't have control. You don't have controls. The market is the market. You have free entry and free exit. That's why they say it's not entity specific. In other words, the entity does not have the control to determine what will happen in the market. It must reflect current conditions in terms of inflations, in terms of interest rate, and all other market conditions, prevailing market conditions. So that is that for that. And then another thing that is in the sorry, please. Another thing that is in that definition is what we call the orderly transaction. When we say orderly transaction, it means that there are no individuals that can influence the buyer or the seller. The entity, for instance, does not have the power to influence the market. A very good example is our online retail store, like what is it called? Like Gigi, Temu, online store like that, like Gigi, Temu, Konga, all those ones. They are free markets. And buyer and seller, they transact. You don't need to ask questions. What they put there is what they put there. That's the price you see there. You understand now? So you can use that to determine the current price of your asset as it were. So that is a very good example of what we mean by there are no, I mean, what we call orderly transactions. The buyers and the seller, they come in there, they do their business. Nobody is influencing anything. Nobody is inducing anything. There is a free entry. There is a free exit. So that's what we call orderly transaction. Then we have the market participant. Market participants are just the buyers and the sellers. As simple as that. And the measurement date is the date of reporting your financial year end usually. So when we say the price, it is the exit price. That is, you are not considering all the other costs to sell the asset. You are only looking at the exact price, the key price. I'm looking for a word to use, but it's not coming. But I'm sure you understand what I'm saying. The exit price, that is the price if you are to sell the asset, or you are willing to pay if you are to transfer the liability between the market participants, at a measurement date. So it's as simple as that. That is the basic definition. I'm sure you have the understanding. Any question before we move ahead? If you have the understanding, please just give me a thumbs up. If you don't, just raise your hand and ask a question very quickly as we proceed tonight. Okay. Thank you so much. So that means we can, okay? Somebody is raising his hand. Okay, all right. I will definitely, certainly, I shall. So quickly, let's continue with the class. So, what are the key assumptions under fair value measurement? The key assumptions are as follow. Number one, fair value is measured, or the transaction for fair value measurement takes place in what we call the principal market. In other words, we have what we call the principal market, the most advantageous market. What is a principal market? A principal market is that market that has high volume of activities. That is, high volume of sales, of transactions are taking place in that market, and that is where usually an entity will go to buy their assets. A very good example is, for instance, if you are into plant and machinery, Alaba, Lagos is a very good example. Many buyer and seller are there. Nobody is using it. So there's a high volume of activities for some of these, what is it called? Some of these plants and machineries. That is principal market. Now, what is the most advantageous market? A most advantageous market is the alternative where there are no principal market. In other words, it is a market that gives you the highest of returns. In other words, when we get to that market now, how to get the calculation better, you understand it. But let me just explain it in this theoretical way. Number one, principal market is a market that has a high volume of activity. And then number two, most advantageous market is a market that is available where there are no principal market. In other words, for instance, if you are into this plant and machinery, you know that Alaba, Lagos now, you can get your plant and machinery very, very freely, or any other places you can get your plant and machinery there. Now, if there are no Alaba market, what is the alternate market that you can go to get your plant and machinery? You understand now? That's what we call the most advantageous market. Okay, after Sabi, you are raising your hand. Please go ahead.
Please, can you take the principal market again? Maybe you can explain a bit because it broke, it cracked the network, so I didn't get to see. Thank you.
Okay, principal market is the market that have a high volume of activity. Principal market is a market that have a high volume of activity. Now, let's do this example so that you understand it better. there is a company Z, let's use I must pass ICANN PSC. Usually buy their goods from X market. This market, let's say they buy their goods from X and Y market. In market S, the volume of activity there is about 1,000. In market Y, the volume of activity there is 200. Which is the principal market? Can you raise your hand and answer? Based on the definition I gave. Okay, go ahead, Aregbe.
Market X is the principal market.
Why did you say so?
Because it is the market that has the high volume of sales. It has 1,000.
Thank you so
And
much.
then
High level of activity, high level of transaction. You understand now? So principal market is the market that has a high volume of transaction. While most advantageous market is the alternative market, the alternate market that is available where there are no principal market. And by explanation, I was explaining using Alaba market. Or let's use Aba market, for instance, Arare market. A lot of things are there that you can get. If you want to buy book, you want to buy anything, materials, you go to that place, you can buy anything there. You understand me now? So that kind of market now is a market with high volume of activity. You cannot compare that kind of market now with, let's say, Okoko Micro market. You cannot compare that. Or compare it with Ikeja market. You understand now? So a principal market is where you have high volume of activity. That's number one. And then most advantageous market is the alternate market that is available where there are no principal markets. Please, these are the key assumptions that you must know under fair value. These three key assumptions very, very important. Number one, principal market and most advantageous market. You must know it. And then the second assumption is that the asset or liability is exchanged in an orderly transaction. I explained it to you the other time. And what was my explanation? There are no undue duress. There are no forced sale. There are no inducement. Nobody is influencing anything. Everything is just going seamlessly. That is number two assumption. Number three assumption is that the market participants, they are independent, they are knowledgeable, they are able, and they are willing to transact. Very, very important. Very, very important. Please know this assumption. Very, very important for you to know. The number one is that the transaction takes place in principal market or most advantageous market where there are no principal market. Number two, the asset or liabilities are exchanged in an orderly transaction. That is, there are no influences. You don't influence the buyer. You don't give them tips. You don't give them bribe. Increase the price. Like some of you will used to do now. You are buying things for your organization. You will now go there. Give me invoice. Add 20 naira to it. That is inducement. Yeah, some of you are still doing it. Please desist. That's fraud. Don't commit fraud again. You are becoming a professional accountant. Okay. They say I'm too fast, so well, it's because I want us to finish this particular standard tonight. So let me calm down then. Okay. But you understand what I'm saying. The key assumptions are in fair value measurements, you have three. Okay, Arego, you've been raising your hand. Well, ask your question.
Yes, sir. Sir, I think we've been talking about movable assets. What about when the asset we want to dispose is land? Can we, like, in the sense of disposing maybe building, let me say building instead of land, building, when a surveyor, is it what you are trying to say? Is it that we call different surveyor to survey the land, or what kind of principal markets are we going to get in the aspect of disposing a building, sir?
Okay, thank you. Now, when we get to the hierarchies, you will understand this thing better off. But for your question that you have asked now, if it comes to land and building, it is expected that you can't be calling surveyor and the likes now. If, for instance, you have a building in Ikeja, all that you need to do is to ask questions. My building is in number 2. Number 3, if they are going to sell number 3, how much would they sell number 3 house? You understand? My house is number 2, Aregbe Close. You understand? And I have number 3 that maybe they put for sale. How much is the value of number 3 in Aregbe close? If it's 50 million, that becomes the current market price of my building. Do you understand it now? So that is what that one, for instance, now is not a principal market. That falls under the most advantageous market. That's why we say where there are no principal market, you use the most advantageous market. Is that taken now? Thank you. So can we move ahead? Now, let's look at the we have been able to define principal market, so there are nothing to do with that. Also, okay, let's look at this example. So it will also buttress, but I think I've given an example that you understand. Now, look at this question. You have two potential market A and market B. The volume in market A is 1,000 units. The price is 95 naira per unit. Transaction cost is 5 naira. Market B, the volume is 200 units. The price is 100 naira per unit. Transaction cost is 10 naira. Which market is the principal market? Which market also is the most advantageous market? So let's look at this together. Anyone can help me out? Which one exactly is the principal market? Which one is the most advantageous market? Can anybody help? Okay, Afsa, please go ahead.
So market A is the principal market. Market B is the most advantageous market.
So how do you determine market A to be most advantageous market?
There's a greatest volume and activity.
Okay, that market B. So how did you
That's
choose
what
market
I
B to
consider.
be? How do you choose market B to be most advantageous market?
Oh no, market A is most advantageous. Then market. No. This is twisted. Sorry.
Could you please go ahead? After you can mute. You have tried.
Okay, for me, market A is the most advantageous. Sorry, market A is the principal market.
Okay.
While market B is the advantageous market. It's market A is the principal because it has a high volume of 1,000 units. And for me, why I place market B as the advantageous because it's the available market if market A is not available.
Okay, now, thank you. You brought this up. There is a way you can also determine most advantageous market by not just looking at transaction. Now, let me state this clearly. When you are determining the principal market, you use volume of activity. Please note that, very, very important. You use what? Volume of activity. But when you are determining most advantageous market, you look at which of the market is giving you the highest of return. Now you are assuming there is no principal market. Do you understand it now? Let me state it again. When you are determining principal market, you are going to use volume of activity. But when you are determining the most advantageous market, you are going to assume there is no principal market. So you are going to do what we call net off to get which of the market will give you the highest return. The one that gives you the highest return between the markets becomes the most advantageous market. In other words, most advantageous market is looking at which one is giving us the highest of return, the net of return. Now, let's look at this question. We are assuming, we have all agreed that the principal market is market A because of a volume of activity. Now, for market A and B, let's assume that there is no principal market. Our most advantageous market will be decided by doing this. Number one, we know that the price, this price that is quoted here, is known as the purchase price, but there is what we call transaction cost. Now, in determining the most advantageous market, you have to take away the transaction cost from the price for you to get your exit price. Let me state it now. Exit price will be equals to the price minus transaction cost. Please take note of this. Take note of this. And please note also, if there is what we call transport cost, you are going to have transport cost. You are not going to less transport cost. Why? Because if there is a transport cost, it means that when you are buying that item, you must, take the asset to the point of view. So you must consider it. Do you understand now? Please take note of that. Transport cost. If there's transport cost, you had it. But for this now, we don't have transport cost, so let's remove it. Now, market A. Please, just hold on 1 minute. Market A now, we have 95 naira as the price. So for A, our A will now be equals to 95 minus 5, and that will be equals to what? 90. Then market B will be equals to 100 minus 10. That will also equals to what? 90. So either of the market, based on this, can be the most advantageous market. Do we understand it now? It is as simple as that. Is it
Yes.
clear? Thank you so much. So now let's look at some other examples. Look at 2 more examples and then we move. Let's look at this question. Entity A has access to the following 2 markets, market X and market Y. The quoted price is 600, transaction 20,000. Quoted price of market Y is 590, transaction cost is 5,000. Market S has significant high
Hello,
volume.
sir.
Yes. Are we together? Are we together? Okay. Market
Yes,
A.
but I
Yeah.
wanted to ask a question based on the one you just did, but don't want to.
Go ahead, please. Ask your question.
I'm asking, are we now saying that market B is most advantageous while market A is the principal? That is what I feel, but I just want you to confirm it for me, sir. Sorry.
And this is what I
The
said
one you
before.
just did.
I just told you that we are assuming that there is no principal market for A and B. We are to determine the most advantageous market. And for you to determine the most advantageous market, you do some calculation. You must get the net.
What is this nonsense now?
You must get the net proceeds. Do you understand it now? So we got 90 for market A as net proceed. We got 90 for market B as net proceed. So either of the two can be a most advantageous market. Do you understand it now? But assuming that maybe we got 95 for market A and 90 for market B, market A will have become our most advantageous market. Is that taken? Thank you. I'm sure you understand. So let's go ahead and look at this question.
Market. Okay. Yes, sir.
Market S quoted
Market.
price is 600.
Yes, sir.
Market Y is
Thank you.
9
Yes.
590. Please, you can mute your mic so that we can have a seamless class. Thank you. So now, market S is said to have high volume of activity. Which market should be used to measure fair value? Oh, my answer is showing already. I'm sure you understand this. So, we are to use market S. Why? Because it has the highest volume of activity. Even though market Y gives a better net proceeds. For instance, if we remove 20,000 from 600, we are going to have 580. If we remove 5,000 from 590, we are going to have 585. So assuming we don't have what we call a principal market now in this particular question, it will mean that the one that give us the highest proceed, which is 600, which is 590 minus 5,000, that gave us 585, will have become the most advantageous market. So, but now we have a market. As they said, we were told it has significant high volume of activity. And so therefore, market A becomes our what is it called now? Principal market. Now, let's look at question 2.
Principal market.
Yes. Let's look at question 2. Using information in question 1 above, if the entity had equal access to both markets and neither had dominant activity level, which market should be used? I think I've answered that in my explanation. But let me see as the class. Very quickly, please. 1 minute. Just within a few seconds. Answer that question as we proceed. Anybody? We are now in question 2. Can anybody attempt it?
Market Y.
Market why? Explain. Please, you are now in professional
That's why.
class. When you are answering your question, you
Because
give justification.
this.
Go ahead, Emmanuel.
Okay, sir. I choose market Y because the level of activities here are the same. So since the level of activities are the same, and when it comes to return, market Y gives higher return. So it will be the most advantageous market since it gives higher returns.
Thank you so much, Emmanuel. Please let me clap for Emmanuel. I'm giving you 2 marks tonight. 2 marks. Please claim it. Give him a very one. That is it. It's as simple as that. Very, very simple. Okay. Let's look at one more question. Then we leave here and move to the next one. So let's look at. I want you to look at question 4. Question 3, you can do it. Question 4. What are transaction costs? Why are transaction costs considered when selecting the most advantageous market but not deducted from the fair value? Can anybody try? Anybody can try that? Okay, let me quickly answer it. Now, thank God for this question because I've already omitted something. Let me go back to the last question that we treated. We said that the most advantageous market will be, in the absence of principal market, we choose the market with the highest proceed, and that is the one of 585, which happens to be market Y. Now, understand this, that we are going to choose market Y does not mean that the fair value, that is the price that we are going to consider, will be this, what is it called? 585. Do you understand it now? Because if you are going to buy this asset, you are going to, and then assuming you are buying the asset now, you must buy it at 595. Is that not so? Are we still together? Let me come again.
Okay. Thank you so much.
Can you recap?
Blessing, please off your video. Can you off your video, please? Blessing.
Thank you.
Thank you.
Okay. Look at it this way. You have principal market. There is no principal market in this question. So we are choosing the most advantageous market. And we have done our workings. And we discovered that by our workings, market Y will now become the most advantageous market because there is no principal market. Having done the calculation, please understand that the exit price that we are going to consider as our fair value will not be 585. I'm just trying to explain it now using this example. Will not be 585. The price will be 590. Please take note of that. So we are only determining which market we will choose as our most advantageous or principal market using the available information. But the price that we are going to always consider or that we are going to record in our financials will be the exit price. And in this instance, the exit price is 590. But remember, we did calculation to get our net proceed. And by the calculation, we chose market Y as our most advantageous market between market X and Y. Why? Because it is a market that gives us the highest volume of return. That is the highest in proceed. And so therefore, understand that for you to do the calculation and get 585 does not mean that the price, that is the price that you will consider, will be 585. That is not fair value price. Please note that, very, very important. Your fair value price is the price itself of that market that is said to be in that market, which is the 590. Why? Because when you are choosing fair value price, we are only using exit price, and exit price does not consider transaction costs and all the other costs that are attached. We only consider the price, the exit price, the standalone price. Is that taken? Do we understand that? Thank you so much. So back to question 4. Why are transaction costs considered when selecting most advantageous market but not deducted from fair value? Can anybody answer now? Since I've given you a clue. I've given you a clue. Can anybody answer why do we do that? Okay, Enab James, go ahead. Okay. Aregbe, go ahead.
because
Okay, go.
because because fair value price is a price that is outright. It cannot be influenced. It's the actual exit price that is known by everybody,
Thank you so much.
according
Because
to my understanding.
you are correct. It's because we are using only the exit price. Only the exit price. Please take note of that. Very, very important. Huh? Thank you so much. I think that will answer our question in the question 4. So let's move ahead and look at the next item. And that is, we are looking at the valuation techniques under IFRS 13. When we are talking about valuation technique, we are talking about, calculation approach. That is what you can use to calculate your prices. Please take note of that. Very, very important. Take note of that. Very, very, very important. So we have 3 main approach. We have the market approach, that is valuation technique, market. We have the cost, and we have the income approach. The market approach talked about the observable price, the price you can observe in the market. You don't need to go and meet any buyer if you choose to. For instance, a very good example is the quoted price of shares in Nigerian stock exchange market. You can just go there and see. They will tell. Once you go there, you see there price of Dangote share 2 naira, price of this one share 5 naira. So that is observable prices. Or for instance, go to these online retail stores like GG and the likes. You see the prices there. You don't need those are observable prices. So that alone, you can just use it to substitute into your fair value exit price. A good example is this. Let us assume that you have a share. I mean, let's say you have share with GTB, for instance, and then you are an investor. You are an investor, as it were, and a part of your investment is that you buy share in a GT Bank. Remember, when we are looking at financial asset, I think you understand this better. You are buying this share for capital appreciation, and so last year it was sold for 2 naira. You don't need to go and look for any other person to be asking how much are they selling it this year. All that you need to look out for is to go to Nigeria Stock Exchange market and how much is this GTB share as at today. If it's 3 naira, you know that the value of your share is no longer going to be carrying your book as 2 naira. It will rather be carried as 3 naira. So that's why we call it observable prices. So that is number one approach. Number two approach or valuation technique is known as the cost approach, and that this talks about the cost that you can use to replace the asset. The cost that you can use to replace the asset. For instance, you have a motor vehicle now, or let's use plant, plant, because that's the one I believe we can easily replace. We want to replace it. Now you have a plant. The worth of the plant is 500,000 naira. But you now make an inquiry. If I'm going to replace this plant that is producing, let's say, liquid soap for me now, if I'm going to replace it, how much will I replace the plant? Now you make that inquiry, and then they tell you it's 600,000 naira. You should know that if you are carrying that plant at 500,000 naira, you are not telling us the truth, because the current market price is now 600 naira, 600,000 naira, which is now higher in value. Do you understand it now? So it must be on the replacement cost of the asset at the current value. Is that taken? And then the third one talks about the income approach. This income approach is the one that discounts the future cash flows into today's value. In other words, this one uses what we call the present value mechanism. That is, you are discounting the future cash flow of the asset. That is, you are able to project. Let's assume I have a plan now. You are not able to project in the next 5 years. This plan will be giving 100,000 every year. What is the present value of that 100,000 in the next 5 years, which is 500,000 in today's value? Because you cannot tell what tomorrow will be. You only know of today. Talking about the time value of money. So the first approach is the market. The second one is the cost, and then the third one is the income approach. It's as simple as that. You can be asked in your exam. I've seen it severally. They have asked this question over and over and over and over again. So that is the three approaches that we have. So let's look at these questions very quickly within the time frame that we have left here. It says you are valuing this one as Broadway.
Please, I did not get the last this thing you mentioned, the last one.
Income approach.
Sorry.
The income approach is a discounting method that is discounting the future cash flow of an asset into today's value. It's as simple as that. Now let's look at this question. You are valuing a newly constructed building and there is no active market for that building. The builder provides detailed cost breakdown. Which valuation method are you going to use? Since there are no active markets and the builder provided detailed cost breakdowns, that is to say, if you are going to build that kind of building, this is the cost. That's what this question is explaining. They say, which valuation method are you going to use? Remember, I told you about cost approach. That is the cost at which you are going to replace the assets. Is that taken? Do you understand that? Is the question clear? Thank you.
Yes, sir.
So let's go to question 2.
Yes, sir.
And this is where I want us to base. Question 2. A patent. Who can tell me what is a patent? What kind of asset is patent? Michael, please go ahead.
Intangible.
Okay, all of you clap for yourself.
Intangible
All of you have
assets.
answered. So clap for yourself. Clap. I'm not giving anybody mark. Just clap. Thank you so much. So, patent is an intangible asset. Blessing, please. You are raising your hands. Go ahead. Okay, let's go ahead. It says a patent is able to generate 20 million annually for 5 years. There is no quote. And what valuation techniques should be used? Who can answer this question? Aregbe, go ahead.
Income approach, yeah.
Income approach. Please, I'm giving you 1 mark. Thank you so much. And how will you do this?
Since we have been given the cash flow for the next 5 years, I think we just have to discount the future cash.
I can't hear you again. Oh. Okay. Now, for you to discount anything, they must give you what we call a discount factor. For this question too, I did not provide the discount factor, but just know I just want to test your understanding of the approaches so far. But you should know that we are going to use the income approach, that is discounting the future cash flow into today's value. But for this question, there is no discount factor. Please look out for it. It's very, very important. For you to use the income approach, they must give you the cash flow. They must give you the numbers of year, and they must give you the discounting factor. Please, very, very important. Take note of that. Thank you so much. Now, hold on, please. Let's quickly look at question 3 and 4. Question 3 says, question 3 and 4. Let's quickly look at it. Please mute your mic. Mute your mic. Mute your mic. Okay. Thank you. Mute your mic, please. Question 3. A company is valuing a listed investment. The current market price is 75 naira per share. Should it use cost or market approach? I've already put the question answer set. Who can tell me why we should use the market approach here? Okay, without wasting time, we are going to use the market approach because that is the observable price. That is the quoted price on the stock exchange market. So it must provide the most reliable evidence for fair value. So understand this. Once you have all of these observable market price, that is the most reliable out of all of the prices that are available for fair value. The most reliable and the most effective that you can use for your fair value measurement. So now for this question, we're told that 25 naira per share is the value of the share. Like the example I used earlier, for if you have an investment with GTB last year, it was 2 naira per share. You don't need to go and meet any GTB person or be asking questions. Just go to Nigeria Stock Exchange. How much is the current share, market share of GTB? That is it. By that, we know what exactly is the current price that you're going to attach to your investment, what you are carrying in your books. That's what we call observable market price. So quickly, let's look at the levels now. I think let's look at the levels. Please take note of it. I told you that we are going to look at about 5 things. About 7 things. We have been able to look at about 4 things all put together. Now let's look at the fair value hierarchy. After all of these deliberation, we will now look at a complex question. It is toward the end of the time. We'll look at the complex questions and we'll give solutions to them. I'm only giving you an explanation now. Fair value hierarchy, that is the input levels. You can be asked. It's not that they can ask you over time that what are the levels or hierarchies of fair value. Fair value has hierarchy. And when we talk about the hierarchy, that is the kind of price that you should use for your fair value. So we have level 1 input. Level 1 input, that is the highest of all. And these are what we call the observable prices. The observable prices. You understand? They are directly observable. You don't need anybody to, for you to know what exactly are the prices. So they are like a good example is the quoted prices on the Nigerian Stock Exchange market. They are the most reliable. They are very observable. That is number 1. Number 2 input or level of input is what we call the other input that are available other than level 1 input. Let me take that again. Input that are available other than level 1 input. Remember, we say level 1 hierarchy are the observable prices. That's level 1. Now, level 2 input or level 2 hierarchy is the other observable prices apart from the one in level 1. Example is when you have a quoted price for a similar assets, the one that you get, for instance, from GG. You understand? Similar assets. Then we have what we call the interest rate curve. I'm sure people that are doing FM, you understand this better. And then we have where we have all these volatilities, that is high level of risk, where risk determine the prices and the likes. So all of these put together, they are, level 2 input. So you don't need much of the explanation, but all that you need to know is this: where you have other observable prices apart from that of level 1. Apart from that of level 1, that is a level 2 hierarchy. So remember, we are discussing about fair value price in terms of hierarchy. Which one is most reliable? Which one is more effective for you to use? And we said level 1 price, which is the observable price. A very good example is the quoted price in the Nigerian Stock Exchange market. Is a very good example, and that is a level 1. That one is very reliable. That is the price. It has no inducement. It has no transactional cost. It is the way it is. Level 2 price, they are the prices that are available other than the level 1 prices. This one now has some little adjustment that you need to make. You understand? A very good example, like I said, is in the price of similar asset, or people that are into bond now, sale of bond and the likes. You can easily see, for instance, now the amount that GTB is trading bond is different from the amount that we are trading that other banks are trading bond. So please let me quickly create another class. I'm being told that the class will end in 1 minute. I wouldn't know why this one is not staying much. So please just hold on. We continue from where we stopped. Just hold on very quickly. I'm going to create another link, and I will send to the platform. Thank you so much. To buy an asset, the price that is being quoted to transfer a liability, that is known as the exit price. It does not take into consideration transactional costs and other relative costs. That's why we call it exit price. And then we went further to give definitions to orderly transaction, and we said it is transaction whereby there are no undue influences. In other words, the transactions are just flowing seamlessly without any kind of influence. And then we talk about the market participant. We say market participant, they are the buyers and the seller. And then the measurement date is the reporting date. And so we move from there to discuss about the assumptions under fair value. And then the first one is that transactions take place at the active market. And this active market can either be a principal market or the most advantageous market. That is number 1 assumption. And we went further to say that the principal market is the market with the high volume of activity. And then the most advantageous market is the market, the alternate market that is available where there are no principal markets. And we said that in determining principal market, we consider volumes, that is volume of transaction or activities. Whereas when we are determining the most advantageous market, we are looking at the one of the market, the either of the market that is giving us the highest proceeds. And that is where we consider, transaction cost. But that we are considering transaction cost do not mean that fair value exit price is the proceed that we get, but rather it is the price of that market that we use as our fair value price. Ishaku Ibrahim, you are raising your hand. Please go ahead and ask your question. Okay, put down your hand if you know you have no question, please. Ishaku Ibrahim, you are raising your hand. Okay. So quickly and then that's where we are actually. Then moving on, we said that we have what we call approaches, that is valuation techniques, methods of calculation of fair value. And we said we have the market techniques or market method, which is the price or the quoted prices that you can observe in the market. And a good example is the quoted price in the Nigerian Stock Exchange market. The price of these online retail stores, they are all market prices that we can use to fair value our asset or liability. And then we move ahead to talk about the second approach, which is the cost approach. And this cost approach has to do with the cost that we can use to replace an asset. The cost that we can use to replace an asset. That is that. And then we give example. Take for instance that you have a plant, and this plant you're using it to produce bread, for instance. You can go and make your findings. If I'm to replace this particular plant, how much can I use to replace it? That replacement cost, if it is higher than the present cost, or if it's higher than the present amount that the current amount of your plant in your book, it means that you are carrying it at a lesser value. In other words, you should be able to increase the value of your asset into what we have as a current price, as a current fair value price. And that is that for that. And the third approach talks about the income approach. And the income approach is the one that discount the future cash flow into today's present value. And I told you that in discounting, three information must be available. Number one is the cash flows itself. Who can tell me the number two and the number three? Just raise your hand and then I'll call you. Michael, please go ahead. Okay. Go ahead, Michael. Michael, are you still there? Are you there? Okay, go ahead, please. Michael, please go ahead.
I thought the number of years and started. Okay.
The discount factor. Thank you so much. So I'm giving you one mark for that answer. Thank you so much. Okay. And then from there, we talked about the third approach. Please mute your mic. Please mute your mic. Franca, please mute your mic. Franca, please mute your mic. Thank you. Usman Blessing, please mute your mic. All right. So, and then we went ahead to also discuss the hierarchies, and that's where we actually the hierarchies of fair value. And when we say hierarchy, what we are simply saying is in order of relevance, in order of reliability, how do you choose the fair value? And we said level one, the future is that it must be observable. That is, it must be a reliable price that you can use. And we say level one is the observable market price. That is the price that is, does not have any other adjustment. It is the price the way it is the way it is. A good example we said is that of the price quoted prices in Nigerian stock exchange market. Very observable. That is the way it is. That's how everybody will buy. You don't have any adjustment to be made to that. And we moved on to talk about the level two hierarchy or impute. And we say these are the other observable quoted prices apart from level one quoted price. And then we said, for instance, a similar price of an asset in a market, a similar price of an asset in a market, or the similar price of a bond in another uh, uh, bond holders or bond issuers, as it were. So all of these are level two impute, and then we have level three impute or level three hierarchy, and that talks about the unobservable prices. That is the one that is you cannot observe the prices. These ones, they are based on the identity assumption. They adjust it to reflect the current market price. This is where you do usually all of these adjustments, as it were. Like for instance, using your discounting method now, the income approach, you generate the future cash flow of an asset and then you discount it to present value. That's what we call unobservable input. This is the lowest in terms of the hierarchy because it has a lower reliability mechanism. Why is this so? Because your projections, you are projecting 100,000 naira in the next 5 years. Who told you that the company will still be in existence in the next 5 years? Who told you that the inflation price wouldn't have even gone up? Who told you that the interest price wouldn't have changed? So that is why it is the lowest in terms of reliability. Is that taken? Any question? Audu Solomon, you raise your hand. Please go ahead. Ibrahim Ibrahim, yes, you raised your hand earlier. You can put down your hands if you don't have any questions. So allow Audu Solomon to ask a question, please. Audu, go ahead. Okay. If there are no questions, let's go ahead and ask ourselves the following questions. We have which input level correspond to a quoted market price for an identical asset? Please reason before you answer this question. Which input level or which hierarchy correspond to a quoted market price for an identical asset? Anybody can attempt? Market, please go ahead.
The level two hierarchy. That's
Level
the
2 hierarchy.
input method.
Okay.
Yeah.
Level 2 hierarchy. Thank you so much. And the reason is simple. It is because it is the one that is available apart from level 1 hierarchy. So let's look at question 3. A property is located in a remote village. The entity uses its own assumption based on expected rental value. Oh, the answer is already here. Okay, let's look at question 4. Please, I hope you are following and you are understanding what we are explaining. I'm sure you understand what I'm explaining. Thank you. So we have this question 4. I will have not allow you to see it. I don't know why you are still seeing it. Okay, let's see. Now let's read this question 4 together. If a quoted price is available for a similar asset but not identical and require minor adjustment, what input levels apply? What input levels apply? This man, Blessing, please mute your mic. Anybody want to try? Question 4. The answer is already there, so there's no need to answer. So use level 2, adjusted price for similar asset, observable input. So now let me just recap. Level 1 basically is for all these quoted prices. Very, very important that you need to know. All these quoted prices of a Nigerian Stock Exchange and the likes, all those quoted prices that cannot be adjusted for any reason, they are they are level 1 quoted price. Level 2 quoted price are the prices for assets, all these similar assets in an alternate market or in an active market. That is level 2. Then level 3, they are the unobservable prices. That is, these are based on the judgment or the conclusion of an entity. And we give example of the discounted cash flow method. This is the income valuation method of fair value. So please just note this. Very, very important, because you can be asked in your question. I can question, I think, 2003 November diet FR. 2003 May diet FR. We were the question was asked that we should itemize the hierarchy of fair value. You have to list the hierarchy the way they are. You have to list it the way they are. Thank you. So let's go to the next that we are looking at tonight, and that is the highest and best use. The highest and best use for highest and best use approach of fair value. Highest and best use approach of fair value. Okay, Moses, you are raising your hand. Go ahead and ask your question.
Thank you very much, sir. God bless you. Please, if the good evening, sir. Thank you very much. I want to ask if a question is asked concerning the hierarchy, as I just said, I want just listed the hierarchy like level 1, 2, 3, without giving example. Will it actually penalize?
Well, let me answer your question very quickly. You see, how you answer your question, the strategy is this: is for you to look at the marks that is attached. If they ask you to list and explain the hierarchies of fair value, please list and explain. If they ask you to explain, let's assume they say explain the hierarchies of fair value and they put 2 marks there, don't bother yourself citing examples. But if they say explain the hierarchies of fair value and they put 10 marks there, you have to write anything you have to write. Is that taken? We are looking at IFRS.
Yes, sir. Thank you, sir.
For Farouk that is asking question, we are looking at IFRS 13, fair value measurement. We have gone far. We are almost rounding up. Please, you can watch the video. I think it will be uploaded very, very shortly, if not tonight, tomorrow morning. So let's look at this highest and best use approach of fair value measurement. You see, this highest and best use approach talks about how to measure, the fair value of a non-financial asset. Now, I think Michael asked me a question the other time about building. You see, you can use this type of approach to measure building where there are no observable inputs. What this highest and best use approach is dealing with are non-financial assets like building and land. Now, you see, the use of a non-financial asset that we must mind is value from the perspective of market participant. That is what we consider under the highest and best use approach. What this is simply saying is this. Take for instance now, you have a building. You have a building, let's say a shopping mall in a residential area. And that shopping mall, people are not even patronizing it the way it's supposed to be. Maybe you have 100 shops in the shopping mall, and maybe only 10 is being used by the people, and the place you are is a residential area. You can choose, to convert that mall to a residential apartment, but you cannot just choose on your own to do it. There are three features that must be subscribed to. That is, there are three what will I put it now? Which word will I use now? There are three what is it called? Give me word now, give me English now. The English is running away. Future characteristics, traits, what must be applicable.
Approach.
Thank you.
Approach.
Required. There are three things that are required. Three fundamental prerequisites. Thank you. Three things, three prerequisites, three approach, three characteristics that must be possible for you to be able to do this. Number one is that it must be physically possible. For you to convert the shopping mall to a residential building, it must be physically possible. Number two, it must be legally permissible. In other words, there must all these documents that are required must be permissible. And then number three, it must be okay, we have looked at physically possible, and then number three is that it must be financially visible. That is number three. So number one is for you to say you are converting that building from commercial to residential, it must be physically possible, legally permissible, financially visible. In other words, you know that your mall now, if you have a mall, just your shopping mall in that residential area, there are no other properties that you can use to value your shopping mall. So the highest and best use approach is advising that instead of continuing in the use of the shopping mall, you can as well convert it to residential apartment. But for you to be able to do that, it must be physically possible, it must be legally permissible, it must be financially visible. Now, when you now convert, that is when you can now say, okay, this is now the worth of my building. I'm just giving an instance. So when we talk about highest and best use approach, it is used for non-financial assets, usually land and building. A good example also is if you have a farm in a particular location, and then you discover that the residential area are also in that place, and the value of the residential area is more higher than the farming that you have. You understand now? You can choose to convert your farm to residential. But for you to be able to do that, it must be physically possible, legally permissible, and financially visible. So it is upon that you can, fair value that farm. But if you have other farms in that area, the values of those farms in that area, their current value will become your own fair value as it were. Please, do you understand what I have just explained? Please give me thumbs up if you do. If you don't, let me also know so that I can recap. Thank you. So that is that for that. Now let's look at this one icon question here. I don't like using quoting the years. That's why you are not seeing some of those icon questions that I will just put them here. And the essence is a lot of other persons are also writing other exams, are also watching this video. Some of them are also joining us in this very particular class. So, icon example, this is a question here, but I won't mention the year. A parcel of land is currently used for industrial purpose, but is located in a rapidly developing residential area. If HBU is for residential real estate and the increase, sorry please, and there is if the highest and best use is for residential real estate and that increases the value, fair value must reflect this, not the industrial use. That's what I've just explained using the example of farming and a residential area. So that is that for that. So let's look at then this question 1. An office, oh God, I have already put the answer. I don't like putting the answer. I don't know why I'm putting the answer for you people to see. Eh? Okay. Now let's look at this question together. Are you seeing my screen? An office building is located in a zone recently reclassified for residential use. Market participants value it more as an apartment. What is the fair value? An office building is located in a zone recently reclassified for residential use. Remember, this one is office building, but it is now reclassified for residential use. Office building is different from residential use. Market participants value it more as an apartment. That is, that zone, people value it as more of residential. What is the fair value that we can use here? Can anybody answer? What kind of approach, being a non-financial asset, what kind of approach are we going to use? So that we will not waste our time, let's just look at the answer and then we proceed from there. The answer is based on its highest and best use, that is residential apartment, because market participant, that is the buyers and the seller, they value that zone to be more of an apartment. It means that we are going to use the highest and best use, and that is a residential apartment as it were. So we must also consider if it is legally permitted, physically possible, and financially feasible. That is that for that. So let's look at the disclosures. The disclosure that is required. Then we look at comprehensive questions. Disclosures under IFRS 13. Very, very important. What are the disclosures? Number 1, entity must always disclose the valuation technique that is being utilized. Very, very important. Number 2, entity must disclose input level that is used, either level 1, level 2, or level 3. And 3, entity must disclose whether the highest and best use approach was considered or valuation techniques. If level 3 is used, that's number 4, if level 3 is used, the assumptions, the model, and the sensitivity must also be stated. If level 3 is also used, reconciliation of opening and closing balances must be done. And number 3, any transfer between the levels must also be disclosed. That is very, very important for our consumption. So please take note of those disclosures. Disclosure 1, you must disclose the valuation. You don't need to remember all. If you just remember these first 3, that's enough. Valuation technique, the hierarchy, and then the highest and best use if it is what is considered. That is that for that. Then you can as well mention if they use the market approach. You can state, instead of using, you just saying valuation technique, you can say if they use market approach, let them state it. If they use, depending on what you should just be always looking out for is the type of answer that is the type of mark that is being awarded to that question. in answering your question. Very, very important. Please take note of that. So let's look at some complex questions, and then we go from here. Question 1. What disclosure is required for level 3 measurement? They are all here. Please, if you get the material, all of these questions, they are here. So let's look at this very good example, because I want us to look at this calculation before we shut down tonight. You own, okay, please, are we still seeing the screen? You own 500 shares in ABC PLC, quoted at 120 naira per share. You also have land held for office use. The book value is 50 million, but can be developed as a hotel, and the market value is 100 million naira. What is the fair value of the shares and the land? Can anybody try? Can anybody try? Are we together? Okay. So we will not waste time. The answer has been provided. Fair value for the ABC share is a level 1 input. We have been given the quoted price. And since it's 500 share, 500 multiplied by 122, that is 60,000. That is using the market approach. We are able to get the 60,000. For the land, because it has alternative use, that is, if you develop it as an hotel, the market value will be 100 million. You can use your highest and best use valuation approach. That is, you consider which one will be useful, which one will give you the highest proceed. If you continue to use, the land for office purpose, your value will be 50 million. But if you develop it to an hotel, it will be 100 million. So which one will you use? You use the highest and best of use, and that is you choose the land as it were. So that is that for that. Let's look at this question again. The fair value. Let's look at this question. Sorry, there is a question I want us to actually treat that has to do with income approach. Sorry. Okay. An intangible asset generates estimated net cash flow of 12 million, 10 million, 8 million for 3 years. The discount rate is 10%. Require calculate the fair value using the discounted cash flow methods. Can anybody try this? Can we all try it? I should do it. Can you still hear me, or are you sleeping already? Oh God, it's already late.
Yes, sir.
Okay. So let's go ahead and do this. I did the workings here. So I'll just explain it to you. See, for year 1, your present value to be 12 million divided by 1.10 raised to power 1. That will give you 10.91 for first year. You can do it this way, or you can do it this way. The way I taught you the last class, 12 multiplied by 1.1 raised to power minus 1. You see, when you are dividing, the minus will go away. In other words, your minus can become a divide and you will still get the same answer. Please help us punch the calculator. What is the answer for this one? Give me answer. Please give me answer. Are we together? Is anybody pressing calculator?
Yes, sir.
So what's the answer for 1?
10 point.
10 point.
10.91.
What is second year is what?
9.1.
Second year.
Okay. Okay, sir. Coming, sir. 8.26.
Okay, 8.26.
Yes.
So odd year is what?
6.01.
6.01. So this is how to, you can as well do it this way. Anyone that you do is the same thing, you get the same answer. You know, I'm doing this, I use this other way of doing it so that a lot of us, we have the understanding of how this thing been done. This is how to do your discounting when it comes to, you know, uh, finding the
Yeah,
present
man.
value of the future cash flow of an item. So that is it. So when you discount all of them, you add all of them together, you're going to have 25.18, meaning that the fair value of this particular intangible asset is 25,180,000. It's as simple as that. And this is the main. This is the only way. This is the only question that can come your way that may be difficult, but I'm sure if you know what we have done in the last class under impairment and this one, you'll be able to handle it appropriately. Farouk, you are raising your hand. Please ask your question.
Yes, but yeah, in a situation where having a different discount rate, how are we going to tackle that one? That the discount rate is not uniform like this.
Whatever discount rate they give to you, you just substitute it into, like for instance, the one we have in that bracket there. Do you understand? But I've not seen where they give you different discount factor. Do you understand me now? Usually, it used to be the same discount factor for all of the cash flows. But in case they give you different, they can come in any way. In case they give you different, different discount factor for each of the cash flow, use the one for each of the cash flow, just the way we did it here. Instead of saying, for instance, if they give us for year 2 now 11%, we'll just say 1.11. If they give us 8% for year 3, we'll just say 1.008. So this is everything about fair value. Is very, very simple, a standard. Where your question can come out from are, number one, they can ask you exactly what are the hierarchy. They can ask you. Number two, they can ask you what are the levels. Number three, they can give you questions and for you to use a replacement cost or to find a market price using the market approach. Like for instance, the share now, they can tell you that GT Bank, for instance, I must pass Icon PSC, have shares of 5,000 naira with GT Bank. The quoted price of shares in GT Bank is 2 naira. What is the fair value? The fair value is the 2 naira multiplied by the amount for that amount of investment that this man has, the number of shares that this person has in GTB. Is that okay? Let me take that example again. I must pack Icon PSC, have 5,000 number of shares with GTB. The current market price of share in GTB is 2 naira. What is the fair value? The fair value is 2 naira multiplied by 5,000 share. That is that for that under the market approach. For the cost approach, the cost valuation approach, they can tell you that a plant is worth 500 million naira or 500,000 naira. If you are to replace that plant, you're going to replace it for 620 million naira. The fair value of that plant is now 620,000 naira. We can under the income approach, they will give you cash flows like the one we are looking at. They give you cash flow, they will tell you what is the fair value. The fair value is you discount all the cash flow into today's present value, and the present value, the net present value that you have, the present value that you have becomes the fair value for that asset. So it's as simple as this. So this standard is not more than this. Very, very simple standard. Just have the understanding of it. Any question they are bringing, deal with it. And I'm sure you have been well grounded tonight. Thank you so much for your time again. Any question before we call it a night? Please, do we have understanding of what we have said so far? Do we understand it? Is it complicated? Thank you.
No, it's not.
Okay, thank you so much. But like I said, the material will be updated
Yes, sir.
on your
Thank you, sir.
reach out to the admin, and then the material will be available. Thank you so much for your time, and we'll meet here next week. Good night.
Thank you, sir. God bless you, sir.